In Chapter 4, we talk about mutual funds and other investment companies. First, what are investment companies and what they can do for us? Investment companies are financial intermediaries that collect money from individual investors and pool the money together, invest in a very wide range of securities. Think about the following situation. Suppose you are an individual investor and you only have, say, $3,000 to invest. Well, it's going to be very hard for you to form a very diversified portfolio. Means you cannot afford to buy a wide range of securities. Buying just one or two stocks can be very risky. If you want to form a portfolio, it need to be at least around 10 stocks. But sometimes the stocks can be very expensive. For example, Amazon stock, one share will cost $3,000, while you only have $3,000 to invest. How can you form a well-diversified portfolio? Well, you can't. But what you can do is you can put your money in investment companies. Like for example, if I am an investment company, I will collect money from you, $3,000. If I can collect money from 100 people, each person gives me $3,000. I will have $300,000 to invest. Well, with this big amount of money, I can form a very diversified portfolio investing in a wide range of different securities. So the investment companies can perform several functions for the investors. The first one is administrative and record keeping. Well, one thing is they can do for you, they issue periodic statistic reports, shows you the performance of the portfolios you invest. And also, very importantly, they keep track of capital gains and dividends. At the end of the year, they will show you the table, the paperwork, which is very important for your tax return in April. Second is diversification, because they are pooling money together so that they will have enough money to buy a wide range of securities to achieve the purpose of diversification, which is very hard for individual investors to do. The next one is professional management. For individual investors, you probably do not have too much time monitoring the portfolios you invested because you have a full-time job and maybe you are a full-time student, so you don't have a lot of time watching the stock markets. But once we put the money together in the investment companies, the investment company can hire a full-time portfolio manager to do the job for us, and we can put our money in professional experts' hands. The next benefit is reduce the transaction cost, because the funds or the portfolio managers most of the time trade in big blocks of stocks, which means they can negotiate a very good deal with the brokerage firms, so their transaction costs are a lot lower than individual investors. Investment companies pool the assets from individual investors and then divide the claims to those assets among investors, which means when you buy shares in the investment companies and your ownership is proportional to the number of shares you purchased. So the value of each share is called net asset value. So the net asset value is the price per share of the investment company. If you have difficulty understanding the net asset value, think about the stock price. When you purchase one share of Amazon stock, it costs you $3,000. That is equivalent to the net asset value to the investment companies. So if the investment company is selling, say, $30 per share, then the net asset value of that investment company is $30. Okay, so that is the price per share for the investment company. So one more time, the net asset value is the price per share to purchase investment companies. Okay, so the net asset value is the basis for valuation of investment company shares. Whenever you want to buy new shares or the portfolio managers want to redeem or buy back the existing shares, those are the basis, the valuation, the price you pay for the share of the investment company. The calculation is net asset value equals the market value of assets minus the liabilities divided by the shares outstanding. So here the shares outstanding means the shares of the investment companies. Now here is a simple example of the net asset value. Now suppose we have a fund manage a portfolio of $120 million stock. Now suppose the fund also earns $4 million to the investment advisors and owns another $1 million for rent. So the total liability is 4 plus 1, $5 million. The fund has 10 million shares outstanding. What is the net asset value? So the net asset value will be total asset $120 million minus the total liability, which is $5 million, divided by 10 million shares outstanding. So the net asset value is $11.5 per share. It means if you want to purchase one share of this mutual fund, it will cost you $11.5. In Chapter 4, we talk about mutual funds and others. Here we have a more complicated calculation of net asset value. Now suppose we have a mutual fund called FinGroup. The portfolio has 4 stocks. Stock A, B, C, D has shares of 200,000 shares for stock A, 300,000 shares of stock B, 400,000 shares of stock C, and 600 shares of stock D. The price for the stocks are $35, $40, $20, and $25 for the 4 stocks. The fund has the following liabilities: management fee, $30,000, and there are 4 million shares outstanding. So what is the net asset value of the fund? Well, first of all, we have to calculate the total market value of all assets. For FinGroup Mutual Fund, the total asset will be the asset of the stock values. So let's calculate all stock values. For stock A, the value will be 200,000 shares times $35 per share. So totally, stock A has a market value of $7 million. Similarly, we can calculate the market value for stock B, C, and D. Then we add them up. The total value of 4 stocks will be $42 million. That is also the total asset of FinGroup Fund. Okay, so the total liability is the management fee accrued, which is $30,000. Okay, so total asset $42 million minus total liability $30,000 divided by 4 million shares. The net asset value is $10.49, which means if you want to purchase one share of FinGroup Mutual Fund, you have to pay $10.49 per share. There are different types of investment companies. The first one is managed investment company. Within this group, we have open-end and closed-end funds. The open-end funds sometimes are called mutual funds. It is the most common type of investment company today. When you buy shares of mutual funds or the open-end funds, you buy the shares directly from the fund portfolio manager at the net asset value. Then, when you want to sell the shares, you don't want the shares anymore. You sell the shares back to the mutual funds portfolio manager directly at the net asset value as well. Well, for the closed-end funds, the shares cannot be redeemed, which means when you buy the shares from the portfolio managers of the closed-end funds and then you don't want them anymore, you cannot sell them back directly to the closed-end fund managers because they are not going to redeem the shares at all. So whenever you want to sell the shares of closed-end funds, you have to sell it to someone else, other investors in the market, and the price is going to be slightly different from the net asset value. The load is the sales commission charged on the mutual fund. Each time you buy or sell the mutual fund, they may charge you a fee, which is the sales commission, to buy or sell the mutual funds. They use the money to pay to the brokers. And we also have other types of investment companies, like the real estate investment trust, the REITs, or hedge funds. We're going to talk each one of them in details in the following slides. First, we'll take a look at the key differences between the mutual funds and the closed-end fund. The open-end funds, or the mutual funds, shares are bought from the fund and redeemed by the fund directly, which means the fund portfolio manager will always stand ready to redeem or issue shares at the net asset value. So whenever you want to buy or sell back the shares, you do it directly to the fund managers. In that sense, the fund has to calculate the net asset value on a daily basis because that is the price for investors to buy and sell. The shares outstanding is a constant changing number because whenever the new shares are sold or old shares are redeemed, that number will change. So for the open end or mutual fund, they always have variable number of shares. For the closed-end funds, once you purchase the shares from the closed-end funds and you don't want the shares anymore, you cannot sell them back to the closed-end fund managers directly. You have to find someone else in the marketplace to buy from you. So the shares are sold among investors, and the fund itself is not involved. Okay? Because of that feature, there is no incentive for the closed-end fund managers to calculate the net asset value on a daily basis. So the price will sometimes sell at a premium and sometimes sell at a discount to the true net asset value because nobody knows what is the true net asset value on a daily basis. The fund will only calculate the net asset value periodically, not daily. The shares outstanding for the closed-end is a fixed number because the fund managers will not buy back or redeem the shares from the investors, so the shares outstanding is a fixed number. The next type of investment company is real estate investment trust. It's very similar to closed-end funds, and it invests in real estate or real estate loans. Let me tell you an example. Now, suppose you really think the housing price in New York City will continue to go up in the future and you really want to invest in this market. But the problem is the housing price is so expensive. It costs you $1 million to buy just a one-bedroom apartment. And most of the people do not have that much money to buy. But you really want to invest in the housing market in New York City. What you can do? Well, what you can do is you can invest in the real estate investment trust. The trust will pool money from individual investors. For example, if you invest $10,000 in the REITs, and the REITs will pool money from 100 people, and each person invests $10,000, then the REITs will pool 100 people times $10,000 each, which is exactly $1 million. With the $1 million, the REITs can invest in one-bedroom condo apartment for you. And then Each one of you, of these 100 people, will have 1% share of the REITs. In the future, if the condo price goes up by 10%, then each one of you will enjoy 10% increase on your own investment, which is $10,000. The REITs are established by banks, insurance companies, or mortgage companies. There are two types of REITs. The first one is equity trust. They invest directly in the real estates. Like in our previous example, the REITs invest in the physical condo apartment for $1 million. The second type is called mortgage trust. So instead of purchasing the condo or the co-op apartments, they invest in mortgages or construction loans. Okay, so let me talk about why REITs are most of the time closed-end funds. Once you purchase that $1 million condo apartment and one of the investors do not want to invest anymore, that person wants his $10,000 back. Is it even possible? No, the fund managers will not be able to return the $10,000 he invested because they already put the money and invested in the condo building. There's no way they can take out the money because this is a long-term investment looking at say 5, 10 or even longer years for the housing price to increase, right? What you can do? Well, when you really don't want to invest in this REITs anymore, you can sell your shares to someone else who is interested in this REITs. In that sense, it's very close, very similar to the closed-end fund. The next type of investment company is called hedge fund. Those are private speculative investment companies. They pull money from certain classes of informed investors, most of the time very wealthy people. The hedge funds are exempt from the SEC regulations, so there is very little information disclosed. Most of the time there is a lockup period. For example, 3 years, which means if you invest $1 billion in the hedge fund, within the next 3 years, you cannot take it back. Most of the time, the hedge funds will charge two types of fees. One is management fee, which is a fixed percentage, say 1% of the total asset management, plus incentive fees. So the incentive fees are the fees charged on the excess return over a certain benchmark, say S&P 500. If they manage your fund and has a superior return over the S&P 500, the excess return part will pay a percentage fee to the portfolio managers. Typically, they are heavily leveraged, means they borrow money to invest. They attempt to explore temporary anomalies in the security markets. So let's take a closer look at the mutual funds, since they are the most important managed investment companies today. Well, mutual funds pool money together to form the economies of scale so that they can achieve the low-cost diversification. So what is fully diversified portfolio? Well, a fully diversified portfolio means you need to have at least 20 low correlated firms or stocks in your portfolio. It is very hard to achieve for small investors. Like in our previous example, if you only have $3,000, you probably can only buy one share of Amazon. There's no money left to buy the other 19 different stocks, right? And also the commissions transaction cost can be very expensive for individual investors because you just invest in such a small amount of money. The proportion of the transaction cost will eat a lot profits from your investments. Also, if you want to achieve international diversification, it is almost impossible, especially in the emerging markets. You really have no idea what stocks to invest in those countries. Well, With mutual fund portfolio managers, all of them will be possible. Mutual funds also provide low-cost investment expertise. They do it by the economy of scales. They spread the cost of security analysis over many investors. Like for example, as an individual investor, if you want to invest stocks in a foreign country, say Ecuador, the information problem is going to be very hard to solve. For example, who are the brokers in Ecuador? Can you trust them? What are the best securities to consider? And there's also a language problem. If you only speak English and you do not understand Spanish, well, you can't really read all the stock literatures in Ecuador, right? And also, it's very difficult to know the foreign accounting standards. But all this information problem can be solved by investing your money in a mutual fund which specializes in Ecuador. Well, that mutual fund can hire an expert who can solve all the problems for you. And the investors will pool their money together to pay that expert. The cost per each investor is going to be very low because you can spread the cost among so many investors. Now let's take a look at what mutual funds are available on the markets. Just like you order food in a restaurant, the first thing you want to check is the menu, right? The menu shows you what foods are offered in the restaurant. So here, when you want to invest in the mutual fund, you want to look at the mutual fund menu and see what types of mutual funds are offered. So the first one is called money market funds. The money market funds invest in money market instruments, for example, commercial papers or CDs. Remember the commercial papers, they are traded in denomination of $100,000, which means for individual investors, it's going to be very hard to invest in commercial papers. But with money market mutual fund, it becomes doable for even small investors. The second type of mutual fund is called equity funds, means they invest money in stocks. We have, broadly speaking, two types of mutual equity funds. The first one is called growth funds. The growth funds invest in stocks that are considered as high growth stocks. They will provide very high returns, means the stock price will increase very fast. The company will develop very fast. Most of the time, the growth funds or the growth stocks do not pay or pay very little dividends. The second type of equity fund is called value or income funds. Those funds will invest in firms paying high dividends. You may not see a very high growth in the stock price. Well, you will see a very or relatively stable high dividends each quarter. You can also invest in specialized sector funds. For example, if you really like financial sectors and only want to invest stocks in financial markets, you can invest in finance sector funds. We also have bond funds, which means the mutual funds will invest in fixed income or bond sectors only. The next option is international funds. Well, we have different international funds. It could be global funds invest in securities worldwide, including US. Or it could be international funds outside the US. Or it can be regional funds focused on a particular part of the world, say Asia or Latin America. Or we could invest in emerging market funds, where invest in developing nations only. So for the international funds, we have many different options. Recall the MSCI indices we introduced in chapter 2. Right? If you go back to the lecture notes and check the table there, they offer a huge menu of international funds. The next type is called balanced funds. The balanced funds will invest in both stock markets and fixed income or the bond markets at the same time. For example, the life cycle funds. The 2050 life cycle fund means this is the fund for people who will retire in 2050. 2080 life cycle funds means this is the fund for people who will retire in 2080. Okay? For the life cycle funds, they will mix the stocks and the bonds from aggressive to conservative depending on when you plan to retire. For the people who will retire in 10 years, the fund will be very conservative. They will put more weight in the bond market than the stock markets because the last thing you want when you retire is seeing a stock market crash, right? Okay, well, the life cycle fund can be very aggressive for people who will retire in 50 years because time is your best friend in terms of investment. You still have a long period of time to go through a couple of business cycles. In our example, the life cycle 2050, the life cycle 2080 are the target maturity fund. Those funds become more conservative as investors age. Whenever the investors approach to their retirement age, they will put a higher percentage in the bond markets and a lower percentage in the stock markets. But we also have a different type of allocation strategy, which is called static allocation funds, which means the mix of the bond and the stock markets are fixed, stable across the life of the funds. And most of the balance funds are actually funds of funds, which means the mutual funds that primarily invest in other mutual funds. Instead of individual stocks or individual bonds, they invest in a group of other mutual funds. The next mutual fund is called asset allocation and flexible funds. Again, they invest in both stock and the bonds market at the same time, but the proportion they put in the stock and the bond markets can change dramatically according to the portfolio manager's forecast of the relative performance of each sector. If the portfolio manager forecasts in the next couple of years the stocks will perform better, he will put more money in the stock markets. If another portfolio manager forecasts in the next couple of years there will be a recession, he will put more money in the bond markets. So the asset allocation funds will engage in market timing. The allocation of the stocks and the bonds mainly depends on the forecast of the portfolio manager, so it can be very subjective. In that sense, it is not designed to be a low-risk investment vehicles. So finally, we have index funds. If you do not want to time the market, like the asset allocation funds, you can do index funds because timing the market is very dangerous. Even the most experienced portfolio managers cannot forecast 100% accurately. If you do an index funds, the index funds will match the performance of a broad market index. Index funds will simply buy shares in stocks included in particular index in proportional to stocks representation in that index. For example, Vanguard 500 index fund that simply replicates the S&P 500 index. The portfolio manager of Vanguard 500 index fund will simply do the following. If GE is 5% of the S&P 500, then the portfolio manager will put exactly 5% of the money in GE in this index fund. So the Vanguard 500 index fund is just a replication of the S&P 500 index. In this picture, we can see about 40% of the mutual funds invested in domestic stock markets. 16% in world equity markets, 21% in bond markets, 13% in money markets, and the 7% in hybrid and other funds. The mutual funds investors can be retail investors or wholesale investors. Individuals and small institutions are retail investors. For example, the retirement account through employers. I have a retirement account with City College of New York, and City College of New York will provide me a list of mutual funds and I can invest. Twice a month, I will put a portion of my salary in the mutual funds provided by City College in my retirement account. So in that way, I am an individual small investors on the mutual funds. Your parents may be buying mutual funds to save money to pay your college tuition, right? So when even maybe you're still a baby, they can start saving money and putting money in the selected mutual funds, hoping by the time you attend the college, the mutual fund will provide a handsome return to pay for the college tuition. Church endowments could also be retail investors in the mutual funds. Church endowments are the donations collected from people who visit the church. Once the church collected money, they form a endowment funds. Those endowment funds can purchase mutual funds for future capital appreciation. On the wholesale side, we have pension funds, insurance companies, or large endowment funds. For example, the insurance companies, they sell insurance policies to their investors. Investors will pay premiums. Investor companies collect all the premiums and pool them together, use the money to purchase mutual funds. Pension funds collect money from individual employees and then use the pooled money to purchase mutual funds. For the large endowment funds, those are most of the time donations from individuals or institutions. The large endowments will also purchase mutual funds either for capital appreciation or quarterly stable income from your investments, say dividends or coupon payments. Now we are going to look at the cost of investing in the mutual funds. This is very important because each time you invest in the mutual funds, the first thing you want to check is what is the cost, because higher cost will eat up your profits. Let's take a look. Most mutual funds will have the following fees. The first one is the operating expenses. Operating expenses are the costs incurred by the mutual fund in operating the portfolios. They include administrative expenses and also advisory fees paid to the investment managers. Most of the time, the operating expenses will range from 0.1% to 1.5% of the total asset under management. The next one is front-end load. A load is a commission or sales charge paid when you purchase the mutual fund shares. For example, if you bought $1,000 of a mutual fund, if the front-end load is 1%, which means 1% of your $1,000 investment, which is $10, is going to be the front-end load charged upfront when you purchase the share. So the $10 is used to pay the brokers who sell you the funds. Well, the good news is the front-end load is maxed at 8.5%, no more than that. And even better news is about half of the mutual funds are no load funds at all. Means when you purchase the mutual fund, they will charge you absolutely nothing. For the low load funds, they range up to 3%. So as long as the front-end load is below 3%, those mutual funds are called low load funds. The next one is called the back-end load, which is the redemption or exit fee. only incurred when you sell the shares. Typically, the back-end load starts from 5 to 6%, and the fee will be reduced by 1% for every year you hold the mutual fund. For example, if we have a 6% back-end load or exit fee, for each whole year you hold the mutual fund, the fee will drop by 1%. So after 2 years holding, by the start of your third year, if you want to sell the shares, the exit fee will drop to 4% only. The 12B1 charges are distribution costs paid by the fund. They can be used to pay for advertising and promotional literatures. For example, the annual reports you received in your mailbox. The 12B1 charges can also be used to pay to the broker's commissions. The brokers who sell you the funds deserve to be paid. Sometimes the mutual funds can use the 12B1 charges as an alternative to a load. The good news is the 12B1 charges are limited to 1% of a fund average net asset per year. When you purchase mutual funds, it's very important for you to check the fee structures because the high cost will eat up your profits from the mutual funds. So suppose now you invest $10,000 in a mutual fund. The fund will charge you a 6% front-end load, which is a one-time fee. In addition, they also charge you annual expense of 1.35%. At the end of the year, they send you the annual report showing you the gross return of the mutual fund is 17.5%. The question is, what is your return after the fees and the loads? Let's do the calculation. Initially, when you put the $10,000 in the fund, you have to pay a 6% front-end load. After the 6% fee, you only have $9,400 left invested in the mutual fund. That money will grow at 17.5% minus the 1.35% annual fees. So after 1 year of holding period, you totally have $10,918. So what is your net rate of return? Your final value is $10,918 minus your initial investment, which is $10,000 out of your pocket, right? Divided by your initial investment of $10,000. The net return is only 9.18%, which is significantly lower than the reported 17.5% because you paid a very high upfront end load. And also, you have to pay an annual expense, which also eat up your profits. When you check the fee structures of the mutual funds, one important factor to consider is your holding period. So let's take a look at this example. Now you want to purchase this mutual fund. They sell two different classes of shares. Class A charge a front-end load of 4%, and that's it. Class B shares, they do not charge any front-end load at all, but annually, each year, they charge a fee of 0.5%. And also when you want to sell the shares, they will charge you a back-end fee, which starts from 5% and fall by 1% for each full year you hold the portfolio, which means until the 5th year, there will be no back-end fees at all. Now, assume the rate of return on the fund is 10% annually, and you have $10,000 to invest. Now consider if you invest in Class A or Class B, holding for 1, 4, or 10 years. Which class do you prefer? Now for Class A shares, because you have to pay an upfront 4% commission, which is $400 on your $10,000 investment, which means the actual amount of money you invest in the mutual fund is only $9,600. Well, for Class B, there is no upfront fees. However, the annual return will drop by 0.5% 12B1 fees each year. So the return for Class B shares instead of 10% is going to be 10 minus 0.5%, which is 9.5%. Okay, so let's take a look of what happens in 1, 4, and 10 years. For Class A shares, if you hold the mutual funds for 1 year, which means $9,600 will grow at 1 plus 10% to the power of 1 year, which is $10,560. For 4 years, that will be to the power of 4 years, so that will be $14,000. If you hold it for 10 years, that will be 1 plus 10% to the power of 10 years, is about $25,000. For Class B, it's a little bit more complicated because now we have to pay the exit fee. If you hold it for 1 year, because you didn't pay any front end load, you have the full $10,000 to grow with. So $10,000 times each year 9.5% return to the power of 1 year. But when you sell after 1 year's holding, you have to pay a 4% exit fee. So after you're paying all the fees, it's going to be about $10,512 if you hold it for 1 year. Okay? If you hold it for 4 years, each year it will grow at 9.5%, but now the exit fee dropped to 1%. So 5% start with minus 4%. After 4 years holding, you only have to pay 1% exit fee. So 4 years holding period return will be $14,000. If you hold it for 10 years, then there will be no exit fee anymore. So the $10,000 will be growing at 9.5% for 10 years. The ending value is $24,000 something dollars. So Class A is better or Class B is better? It really depends on your investment horizon. If your investment horizon is very short, such as 1 year, Class A is better because the front end load and back end load are equal for 1 year holding period. And Class A doesn't have to pay the 0.5% 12B1 fees. For a longer horizon, moderate horizon, for example 4 years, then Class B is better because the front end load of Class A 4% is more costly than the combined 0.5% 12B1 fees and the now smaller exit fees 1%. For a longer horizon, say 10 years or more, Class A again is better. Why? Because the one-time 4% front-end load is less expensive than the continually 0.5% each year you have to pay. One drawback of the mutual fund is you cannot buy and sell mutual funds like you buy and sell stocks throughout the day. For example, if you place an order to buy Google stock at 10 a.m., you place the buy order on the market order and you can buy Google stock at whatever the market price. But for mutual fund, it's a different story. If you place a buy order at 10 a.m., you do not have the net asset value or the price of the mutual funds yet. When you place the order at 10 a.m., you have to wait until the market closed at 4 p.m. and the mutual fund calculates the net asset value, which is the price of the share of the mutual funds on a daily basis. So every single day after the market close, the mutual fund will calculate the net asset value and the investors will be trading at that price level. So you place the order to purchase a share of mutual fund at 10 a.m., but you have to wait until the market closed and calculate the new net asset value and trade at that price level. But what if you want to buy and sell mutual funds throughout the day, just like you buy and sell the stocks? So each time you place the order, you can buy at the current market price. Well, then we have the ETF, the exchange traded funds. The exchange traded funds are like mutual funds, but they can be traded throughout the day just like you trade stocks. Some good examples of the ETFs are Spiders, which is the replicate of the S&P 500. Diamonds, or DIA, is the replicate of Dow Jones Industrial Average. Cubes, or QQQ, is the replicate of the Nasdaq 100. So here are some potential advantages of trading ETFs instead of mutual funds. First, the ETFs can be traded continuously throughout the day as long as the market is open. So as long as the market is open, you place an order and you can buy and sell at whatever the current market price. You do not have to wait until the end of the day and the net asset value is calculated. So ETFs in that sense is more like stocks instead of mutual funds. The second potential advantage is you can buy or sell ETFs on margins, which means you can borrow funds to purchase ETFs, but you cannot purchase on margin on mutual funds. Potentially, ETFs have lower tax rate. Well, this is a little bit tricky. Why ETFs have lower tax rate? Well, for the ETFs, once you purchase the shares of ETFs, if you don't want them anymore, you sell the shares to other investors. You cannot sell back the ETFs to the ETF fund managers. But for the mutual funds managers stand ready to buy and sell the shares. Once you purchase the shares and hold it for a couple of days, for example, then you don't want it anymore. When you sell the mutual fund shares, you have to sell the shares back to the fund managers. Well, when you sell the shares, you demand money from the portfolio managers of the mutual funds. Where does the money come from? The mutual fund managers will have to sell shares in the position and get the cash to pay you. But the problem is when the mutual fund portfolio sell shares, they incurred capital gain tax. They have to pay taxes on the realized capital gains. So that is why the mutual funds will have a higher tax rate than the ETFs. Okay, so the ETFs also have a lower cost because they do not have to do any marketings and they have lower fund expenses. Why they don't have to do marketing? Because they are replicate of indices. Everybody knows what is S&P 500. The ETF of S&P 500 sells itself. It doesn't really need any brokers. Lower fund expenses because it's a replication of S&P 500, for example, replicate the index. There is really no market timing or any sort of active management involved at all. So the fund expense is very low comparing to the mutual funds. But what are the potential disadvantages? Well, the potential disadvantage is the price will depart from the true net asset value by small amounts. Because the ETFs are traded continuously throughout the day without calculating the true net asset value. So at that moment, the market price could be deviate from the true net asset value. In this table, we showed some important ETFs and the most popular ones. You can take a look, and if you want to include ETFs in your portfolios, those are the good ones to start with. I will take one example. The broad US indexes. If we look at the spiders, the ticker or the trading symbol of the spider ETF is SPY. So if you want to buy or sell the S&P 500 ETFs, you type in SPY, the ticker, you will be able to find this ETF, and then you can buy and sell it. This picture shows you the rapid growth of the ETFs. Starting from 2004, you can see there is a huge increase in the demand of the ETFs. We look at the thick blue line, which is the total number of ETFs. Starting from 2004, there are around 100 ETFs. Until 2017, there are more than 2,000 ETFs. Basically, all major brokerage firms will have their own ETFs. And you can see the asset under management of the ETFs also dramatically increased from 2004. At the end of 2017, the total asset is more than $3 trillion. So why the ETFs are growing so fast over the past decade? Because ETFs are replicates of indices. Why everybody loves indices? In this picture, I will show you one important reason. Dalbar is the nation's leading financial service market research firm, founded in 1976. Each year, it released a study shows the average return of individual investors versus the average return of the S&P 500. The study shows that the average investor earns less, in many cases, much less than the benchmark returns. For example, the release in 2019 report, it reports over the past 20 years, the average return annually across all individual investors is about 5.29%, while S&P 500 the average annual return over the past 20 years is 7.2% each year. The difference is individual investors, are making 1.91% less than the S&P 500. If you look at the past 10 years, past 5 years, past 3 years, the average annual return of individual investors always lower than the S&P 500 returns. The difference are all negative numbers. Well, you may say 1%, 3% difference is not really that much at all. Well, if you're accumulating over a long period of time, it's going to show you dramatic difference. The bottom table will show you the dramatic difference across different years. Initially, let's compare two investments. You put $10,000 in S&P 500, which is the red bar, and then you put $10,000 in your individual brokerage account, buy and sell, select your own stocks. 20 years later, on average, if the investor is making 5.29% each year over the 20 years, $10,000 will grow into $28,000. Well, the S&P 500 index, the $10,000 will grow at 7.5% return to $40,000. If you're looking at an even longer term, for the next 40 years, individual account will grow from $10,000 to $78,000 at 5.29% each year. But S&P 500 will grow from $10,000 to $161,000 at 7.2%. You can see the difference is dramatic. After 40 years, if you put your money in the S&P 500, the terminal value is going to be double the amount than you put your $10,000 in the individual account. So why cannot individual investors beat S&P 500 index? Mostly because of the psychological factors, which accounts roughly 50% of the cases. For example, there is a market crash, means all the stock price dropped significantly. All the stocks are currently on sale. But instead of buying the on sale price of the stocks, most of the individual investors panicked. They feel like more disasters will come, the stock price will drop even further. So they panicked and start selling their positions. They want to get out of the stock market as soon as possible. So instead of buying the stock at a discount price during the financial crisis, they leave the market as soon as possible, selling all their stocks at very, very cheap price. That's one reason. Okay. Other reasons could be whenever there's investment opportunity, they do not have enough capital to do the invest, or there will be capital needed for other purposes. If individual investors cannot beat a broad market index, how about professionals? How about fund managers? The textbook reports a very famous study comparing the average return of the actively managed funds versus a very broad market index, which is the Wilshire 5000. It includes all 5,000 stocks in the market. So this is a really broad market index. Over the past 46 years, from 1971 to 2014, it shows the average return of the active fund managers was below the return on the index in 20 out of 46 years. The average return over this time period was 12% on the index, which is 1% higher than the average of the mutual funds.